Trading options is often extremely risky. When buying put or call options, you can easily lose your entire principal, and selling naked put options can leave you exposed to a loss several times greater than your initial proceeds. However, selling cash-secured put options is one lower risk option strategy that could benefit long-term investors looking to buy a stock at a lower price. In this video, I'll be explaining how to sell cash-secured put options, when to use them, and their advantages and disadvantages versus other stock buying methods. We will also walk through some real examples using my put selling spreadsheet template. Timestamps and all links to resources will be in the description. By the end of this video, you should have a good sense if selling cash secured put options is something that fits within your portfolio and investment strategy. Starting off with a basic refresher, what is a put option? Well, simply it's the right to sell a security on or before a certain date. Every put option contract controls 100 shares. The strike price is the price at which the put owner would be able to sell shares at or before expiration. The expiration or expiry date is the date at which the options contract terminates. Option premium is the amount of money that the option holder paid to obtain that put option. These are the common definitions from the put holder's perspective, but now we'll be taking a look at what it means to sell a put option. Also called writing a put option, when you sell someone a put option, you are selling them the right to sell you shares at a predetermined price and date. Selling this right obligates you to buy those shares from that person at the stake price if the option is exercised. In exchange, you'll be paid the option premium in cash, which is the amount that the option buyer is willing to pay for that specific put option. So that's selling a put option, but what specifically is selling a cash secured put option? Selling a cash secured put option means that when you're selling your option, you also have set aside the cash necessary to buy all of the shares at the stake price should the option be exercised. This cash amount you need to put aside is the strike price times the 100 shares per contract times the number of option contracts you've sold. For example, if you wrote a single put option for Intel stock at a strike price of $50 per share, you would need to set aside in cash 50 times 100 times 1, or $5,000, in case the option is exercised by the expiry date. So that's a basic overview of writing a cash secured put option, but why would you want to sell them in the first place? Well, selling cash secured put options allows you to generate extra income in the form of options premiums by committing you to buy a stock at a predetermined price. For stocks that you want to own long-term and add to your portfolio, selling cash secured put options could be one way to potentially buy those stocks at a lower price. Keep in mind, however, you will only want to write a cash secured put option if the net price, being the strike price minus the option premium that you've received per share, is an attractive price that's a fair valuation for a long-term investment. So what are the advantages and disadvantages of writing a cash secured put option versus other stock buying methods? Well, as for some of the advantages, the most obvious one is the option premium that you'll collect. By selling the cash secured put option, you'll collect the premium regardless of whether the option is exercised or not. Additionally, for many options sold, time decay will gradually erode the value of the option over time. This could potentially allow you to buy back the option and close out the position early, which would release the cash you put aside from future obligations to buy the stock. Selling a cash secured put option is also less flexible than a limit order, which could be seen as an advantage or disadvantage, the advantage perspective being that if by selling this cash secured put option, you're less likely to change your mind based on potential emotional factors. And a final advantage is if the option is not exercised, you can simply write another option and collect more option premium. There are, of course, several disadvantages to using cash secured put options instead of other more direct buying methods. For instance, when compared to a limit order as mentioned earlier, selling a cash secured put option is much less flexible. If you change your mind on selling your put option, you'll have to buy that put option back in the open market to close your position. So with this in mind, you have to be committed to buying the stock at the strike price of the option that you wrote. Another disadvantage is that it locks up that cash or capital that you had to put aside until the option is expired. What this means in practice is it's possible that the stock price might fall below the strike price before expiration, and in your mind that might be a good value and quite an attractive price. However, you've already committed now to buying at the higher strike price, and if you want to buy that lower price, you may not have the capital available since you already put aside some cash when writing this cash secured put option. So you have to understand that writing this cash secured put option does lock up that capital until that option position is closed. Another potential disadvantage, particularly for smaller investors, is that when you sell a put option contract, the smallest denomination you can sell in is one contract, which is the equivalent of 100 shares. You cannot buy or sell fractions of an option contract. For smaller portfolios, 100 shares of a stock might represent a large portion of the total portfolio. Given this, selling cash secured put options may not be suitable for smaller portfolios, and you may want to wait until your portfolio is of a size where you can purchase 100 shares of a stock and still maintain adequate diversification across your entire portfolio. And a final disadvantage, in this case compared to buying the stock outright, is when the stock price continues to rise. If the stock is currently at a price that you believe is an attractive value, you might consider buying some of the stock now, as opposed to solely relying on selling a cash secured put option. The reason being is that if the stock price continues to rise, while you do collect the option premium in the case of selling a cash secured put option, you don't actually own the stock. The only case you would own the stock is if it closed below the strike price at expiration. Selling cash secured put options can help minimize some of the downside risk when entering into a stock position, but it does forsake the potential upside if the stock does continue to rise. Overall, selling a cash secured put option is less flexible than a limit order, which would simply execute as soon as that limit price is hit. With writing the put option, you will only be assigned shares if the stock price is below the strike price at expiration. Now, to compensate you for that risk, you are paid the option premium. So when you sell a put option, you need to make sure that the option premium adequately compensates you for the risk if the stock goes down, as well as the opportunity cost if the stock goes up and the put option is not exercised. So with a better understanding of the pros and cons of selling cash secured put options, when does it make sense for a portfolio and investor? Well, selling cash secured put options makes sense for a long-term investor when they're interested in buying and owning a stock, but at a price lower than it's currently trading. If you're willing to give up the flexibility of a limit order, you can sell a cash secured put option to get paid a premium while committing to buy the stock at your specified strike price. If the stock is already trading at a price you believe to be an attractive value, you should instead consider directly purchasing at least a portion of your full intended position, using a market order or a limit order close to the market price to make sure you don't miss out on the potential upside. How can you get the ability to write cash secured puts within your brokerage account? As mentioned at the beginning of the video, options trading can be very risky, which is why most all brokerages do not allow options trading within your brokerage account unless you file a separate application specifically requesting to do so. In filling out the application, you'll be asked what level of options approval you're seeking. These levels usually range from 1 to 4, with level 1 being the lowest risk option strategies, and level 4 being the most risky or most advanced. Getting approval for any level also allows you to perform all option strategies at lower levels. However, we'll be looking specifically at cash secured put options today. Now, what level of options approval you need to request will depend on your brokerage, but for example with Vanguard, you can sell cash secured put options at a level 2. So in filling out an application for Vanguard, you would request approval for level 2 options. Again, you'll have to check with your own individual broker to see at which level you are allowed to write cash secured put options. Keep in mind, having your account approved for higher levels of options opens you up to more advanced and risky option strategies. So while you now may have access to them, you should stay disciplined and not use any that would go against your long-term portfolio strategy. Now, an in-depth discussion on put option pricing is beyond the scope of this video, but we'll discuss the key factors that influence the price or premium of a put option. Those factors being the difference between the current stock price and the strike price, the amount of time remaining until the expiration date, and the implied volatility of that stock. The greater the difference between the current price and the strike price, the less the option will be worth. Keep in mind the option will only be exercised and have any terminal value if the stock price goes below the strike price at the expiration date. If the strike price is significantly below the current stock price, then it makes it much less likely that that option will be exercised, and thus the value or premium of the option would be lower. All else equal, the greater time remaining until expiry, the more the option will be worth. Options with expiration dates farther in the future have more time for the stock price to potentially fall. This would make the option worth more than an equivalent shorter dated put option. And finally, the greater the implied volatility of the stock, the more that put option will be worth. Stocks with higher implied volatility are expected to see larger price swings compared to stocks with lower implied volatility. Given the greater chance for volatile stocks to see large price declines, put options on these stocks are typically worth more. When you're writing put options, you should always keep in mind any potential upcoming earnings reports or other major catalysts for the stock. These are events that may have an outsized impact on the short-term price of the stock. This will likely be reflected in a higher implied volatility and thus higher option premium compared to an option of a similar length without any new earnings reports. So putting all this together, options that will sell for the most premium today are long-dated options on highly volatile stocks with a strike price that is above the current stock price. The options that will sell for the least premium or be completely illiquid because no one wants to buy them will be shorter dated options on low volatility stocks that have a strike price below the current stock price. With little chance of exercise, except in some very rare tail and risk scenarios, most of these options will end up worthless. The options that you'll likely benefit the most from selling are somewhere in between this spectrum. So to provide you an example of how this would work, I'll explain my personal cash secured put option selling strategy. So first off, when I'm writing cash secured put options, I will only write these options on quality stocks that I'd want to hold in my portfolio for the long term. By having this upfront criteria on which stocks I'll be willing to write options on, this narrows the list of potential options considerably. Fortunately, I have personally built 2 quality stock watch lists, an A tier and a B tier, which in total contain over 100 stocks to choose from. And then for each of these 100 stocks, I will individually value them to determine what would be an attractive long-term entry point for each stock. These buy targets are then compared to the current stock price and are ranked live in my value quant model to help determine the best possible opportunities at any given point in time. It's usually from the highest ranking stocks in the value quant model that I pick my candidates for writing cash secured put options. If the model has some stocks listed as a buy right now, those would probably be candidates for purchasing directly, but if some are close to that buy price but not quite there yet, those would probably be the most ideal candidates for writing cash secured puts. So once I have a stock selected, I'll usually look at the options that are dated out roughly 30 to 45 days. While longer dated options certainly offer more premium upfront, I don't want to lock up my capital for long periods of time. This is the reason why I generally prefer writing shorter dated options about a month and a half long. If the option expires worthless and I'm not assigned shares, I can simply rewrite another put option for the next month out. So when looking at options at that time frame, I'll then look at the put option quotes at strike prices at or below what I'd be willing to pay for the stock. Typically, these will be strike prices that are out of the money and might be 8 to 15% below the current stock price, depending on the stock. What I'm looking for is to sell a put option at a strike price I'd be willing to pay and at an option premium that yields roughly a 12% annualized return. For a 30-day option contract, that would be an option premium of roughly 1% of the strike price. To get a close approximation of the annualized yield, take the option premium and divide that by the strike price, and then divide that by the option length in years. Additionally, as a general rule, I will never use 100% of my available capital for selling cash secured put options. The reason is I always like having at least some unrestricted cash available for potential future price declines. If all of your cash is already committed through cash secured puts that you have written, you wouldn't be able to access that cash if other opportunities came up. Unless, of course, you close the put option, which could be for a loss. By using this strategy, I don't lock up my capital for more than 45 days, but during those 45 days, I am earning a 12% annualized yield. If the put option is exercised at the strike price, then that's good too, because it was executed at a price that I valued could provide a 10 to 12% annualized return by owning the stock at that price. So in this case, assuming the return assumptions I have on the stock hold true, I'll be earning a 10 to 12% annualized return either way. If the option gets exercised, I get to own the stock at a good price. If not, then I can simply write another option and collect the premium. So now we'll take a look at some real money cash secured put options that I wrote in the past. For these examples, I'll be using my put selling spreadsheet template, which is a downloadable resource for members of my investing platform, which is linked in the description below. though keep in mind that these calculations are relatively simple and you don't necessarily need a template to sell put options effectively. The first put option we're looking at is an option I wrote on JP Morgan Chase at a strike price of $90 per share, which expired in roughly 31 days. This was a fairly standard put option sale, again on JP Morgan Chase with a strike price of $90 per share. I wrote the option on July 21st, which would expire 31 days later on August 21st. When I wrote the option, the stock was trading at $99.50, which would mean the stock would need to decline 9.5% for it to be in the money and exercised on expiration. The option premium was 99 cents per share, so after the $1 commission, I got $98 for selling this option. In exchange, I had to put aside $9,000 of capital to be ready to purchase 100 shares of JP Morgan Chase at that strike price of $90. Taking the proceeds and dividing it by the capital I needed to put aside, this was a return of roughly 1%, and if you annualize that, is roughly a 12-13% annualized return. So again, a fairly standard option on a quality stock I was interested in owning at a specific price. In this case, over that 31-day period in time, JP Morgan Chase never traded below that $90 strike price and ended at $97.32. So the option expired worthless, and I ended up writing another one the next month. The quoted closing price of that option is in red, and you can see the value of that option decay over time. As a cash secured put option seller, the price of the option really doesn't mean anything to me after I've sold the option, but I thought it'd be interesting to at least show it here for illustrative purposes, what's sort of going on behind the scenes with the option pricing. Another put option I wrote was for ULTA Beauty, in this case at a strike price of $170 per share. I wrote that option on August 17th, and it would expire September 18th. When I wrote the option, the stock was trading at roughly $225 per share, and I received an option premium of $169 after commission. This required me to put aside $17,000 of capital to be ready to purchase those 100 shares. Interestingly, this was actually a high volatility stock with an upcoming earnings which could prove a catalyst, which is how I was able to still achieve a 1% return on this cash secured put option, but in this case, compared to JP Morgan, at a much lower strike price. In this case, the stock would need to fall nearly 25% for the put option to be executed. Now at $170 per share, this is a very attractive price in my view for ULTA Beauty, so I was more than happy to take advantage of this elevated volatility by selling an option and collecting an unusually high options premium. More generally, you typically benefit as an option seller from elevated volatility as it gives you more option premium when you sell and also gives a greater chance of your put option being exercised, so you get assigned the shares that you ultimately wanted to buy. Theoretically, I could have gotten even more option premium had I selected a higher strike price, but I opted with the higher margin of safety at the price I was comfortable at $170 per share. In this case, again, the option expired worthless and I collected the premium. Note that the option price actually increased significantly following my initial sale, meaning that had I waited 5 days to sell the put option, I would have gotten $287 in option premium instead of the $169 that I did. There's no way to predict these kinds of moves in the short term though, so don't get discouraged if this happens to you. You can see that the value of the option dropped significantly following earnings. This is due to both a favorable earnings report causing the price of the stock to rise, as well as a phenomenon called IV crush, which is where the implied volatility of a stock falls considerably after a corporate event like earnings. And now we'll take a look at a final cash secured put option I wrote, in this case on the stock of ANTM, a health insurer. And this put option in particular is kind of interesting because it's one that I deviated from my normal put option selling strategy. In this case, the strike price of $260 for ANTM stock was what I viewed already to be an attractively valued price. Now, at the time, I had already owned some ANTM stock in my portfolio, but I was very willing to own more at this price. So given that the stock was trading already at $266, it only needed to fall roughly 2% in price for the put option to be exercised and for me to be assigned those shares. The reason I sold this put option was because it was during a period of unusually heightened volatility. It was a very short-dated put option, and it was on a stock that I knew I wanted at a specific price. In this case, the option expired only 9 days after I wrote it, but my proceeds from the option sale were $399. However, I had to put aside $26,000 in order to be able to purchase those 100 shares of ANTM if the option were to be exercised. This provided a return of roughly 1.5%, which translated to a very high annualized rate of return, but that's mostly a function of the very short duration of the option contract. As an alternative to buying a stock outright, you can sell a put option on the stock at a strike price very close to the current stock price, which would increase the likelihood that the option does get exercised. You get a higher option premium, but there is the risk that the stock price could fall even further below your net purchase price, being the strike price minus your option premium. In this case, the option was actually in the money for a period of time prior to the expiration, though it ultimately expired worthless. It's worth noting that while the option holder has the right to exercise the option at any time, due to the time value associated with the put option, typically all put options are held to expiry. This is not always the case though with call options, which have a higher chance of early exercise. So in this case, I collected the premium after 9 days, and instead of writing a new put option, I ended up purchasing shares directly. So hopefully these examples give you some real world data of what selling a cash secured put option looks like in practice. If you have the capital available and there are some quality stocks that you would like to add to your long-term portfolio, selling cash secured put options might make sense for you if you understand the risks. Hopefully you found this guide useful. If you did, feel free to leave a thumbs up to let me know and subscribe for more content in the future. If you're interested in joining my investment platform with a put selling guide, quality stock watch list, value quant model, and a whole bunch of other stuff, you can check that out in the link in the description below. Until next time though, thank you so much for watching. My name is Michael, and I will see you in the next video.